Good evening, everyone. My name is Adam Livingston. I am the Bitcoin Wizard, and we just saw the greatest earnings call in the history of corporate finance. I highly recommend everyone head on over to the Strategy YouTube channel to watch the entire thing. It is an absolute masterclass. That said, this is my take on things. If you'd like to continue to hear daily Bitcoin insights and alpha during the greatest wealth transfer in human history, please like this video to help the algorithm so we can orange pill the masses and hit the subscribe button so you never miss anything. Before we dive into 10 slides of high-octane numbers, let's align on the stakes. Strategy, yes, the former MicroStrategy that swapped a 4-syllable tongue twister for a one-word mission statement, just booked a $14 billion operating profit in 90 days. That isn't a typo and it isn't a crypto meme. It's a public GAAP signed off by auditors who probably needed a cold shower afterward. What you're about to see is how a legacy software firm reverse engineered a balance sheet into a Bitcoin reactor, then turned new accounting rules into a revenue accelerator. We will break down the fair value shockwave, the capital raising assembly line, and the discipline that keeps Bitcoin per share climbing even when new shares hit the tape. By the end, you should walk away knowing exactly why Q2 2025 is less a quarter and more a blueprint for corporate balance sheets in a post-scarcity era. Grab your coffee or your cold storage device and let's light this candle. All right, now welcome to the fireworks factory. First headline, $14 billion operating profit in a single quarter. That is enough cash to buy the entire NHL twice and still tip the Zamboni drivers. Net income rings in at $10 billion, a 97x flip from last year's $102.6 million loss. Wall Street analysts crashed harder than Windows ME when that line hit the press release. The secret ingredient? FASB. The world finally decided that Bitcoin should count at fair value. Strategy poured its unrealized gains through that rule and the income statement lit up like Times Square at midnight. Diluted EPS sits at $32.60. Put differently, the company earned roughly one McChicken per share every 3 seconds during Q2. Accountants started speaking Satoshi, strategy answered with a full-throated opera, and the encore is just beginning. Now that first ingredient, FASB, beginning with the fiscal years that start after December 15th, 2024, companies must carry eligible crypto at fair value and run every penny of the swing through net income. Strategy adopted the rule the minute it was permissible, so the Bitcoin pile now shows up in living color on the P&L. Between March 31st and June 30th, Bitcoin climbed about 35%. Apply that move to 597,325 Bitcoin, and you land on roughly 14 billion of unrealized appreciation, the exact figure that detonated inside operating income. Because the gain is booked inside digital asset fair value change, it elevates operating income, EBITDA, and EPS in one sweep. Any analyst who tries to value strategy on earnings multiples today winds up modeling the Bitcoin price curve instead of a software firm's margin profile. Speaking of software, the core business posted $114.5 million in revenue during the quarter. A tidy proof of life, yet it is a candle next to the supernova created by fair value accounting. The lesson: when accounting finally speaks Satoshi, a balance sheet bet can roar through the income statement and rewrite every traditional metric overnight. That is why Q2 looks less like a quarter and more like a Bitcoin halving event for GAAP. Let's ground the whole story in the asset base. On June 30th, 2025, Strategy held 597,325 BTC. At quarter ends, that stack carried a cost basis of about $42.4 billion and a fair value around $64.4 billion using period prices. That is the balance sheet core that powered the income statement this quarter. Since quarter end, the company continued accumulating. By late July, today, the disclosed balance reached 628,791 BTC, which is roughly 3% of all the Bitcoin that will ever exist. The increase after Q2 validates the flywheel: raise capital, buy coins, expand collateral, repeat. Two quick sensitivities that matter for everyone modeling this name. Every 1,000 move in Bitcoin shifts the portfolio's fair value by 600 $29 million at 628,791 BTC. $10,000 swing is a $6.3 billion delta to fair value. That convexity now flows through earnings under the new accounting. At Q2 levels, a 5% Bitcoin move is a multi-billion-dollar change to reported operating income in the following period, because crypto is now measured at fair value with changes in net income. Management also tracks BTC Yield as an execution KPI. Year-to-date through late July, they cited 25% BTC Yield, which blends the pace of issuance, cost of capital, and coin accumulation against the starting base. The signal is simple: more efficient capital in, more coins out. Read the posture this way: the core software business is steady, the Bitcoin stack is the engine, and the volatility of BTC is now accounting visible every quarter. That is exactly why the holdings, their cost basis, and the cadence of post-quarter buys are the first three numbers to memorize from Q2. And with BTC Yield being the master dial, Q2 posted 19.7%, and by July 29th, the year-to-date figure hit 25%, already meeting the original full-year target. Management has now promptly raised that target to 30%. One quarter delivered 4/5 of the entire annual goal. Q2 alone added 88,109 BTC. Year-to-date stands at 111,894 BTC. Translation: roughly 970 coins a day during the quarter. About 3 industrial-scale mining farms' output secured without burning a single kilowatt. Do you realize how insane that is? Seriously. Rewind this 10 seconds and hear that again. Why these KPIs matter: because capital efficiency strategy raised $6.8 billion in Q2, and by quarter close pricing turned it into nearly $10 billion of Bitcoin value, a 1.5x uplift before any price appreciation. Also, shareholder alignment: because BTC Yield is expressed as coin growth relative to the starting stack, it directly offsets dilution. A 25% yield against 10% share dilution still grows Bitcoin per share. And also, we love the flywheel visibility. Management treats BTC Yield the way a software as a service firm treats net retention. If the number climbs, leverage compounds automatically, and every future quarter arrives preloaded with more potential fair value gain. Bottom line: keep BTC Yield in double digits, keep cost of capital below Bitcoin's appreciation curve. Strategy's accumulation engine doesn't just fund itself, it snowballs. Now let's examine the fuel line that keeps the accumulation flywheel roaring. Number 1, common stock ATM, the warhorse. During Q2, Strategy dripped out 14.23 million shares through its at-the-market program, netting roughly $5.2 billion US. The spread of the multiple to the net assets is the definition of accretive dilution. Another 1.1 billion hit the tape in July, leaving 17 billion of shelf capacity ready for opportunistic taps whenever mNAV pushes higher. And then obviously we have the preferred ATM trilogy: bespoke fixed income bait. Strike with the 8% coupon raised 447 million in Q2 and another 71.8 million post-quarter. Roughly 20.5 billion capacity remains. Strife, the 10% coupon cumulative guy, took in 163 million in Q2 plus 55.8 million in just July. 1.9 billion capacity still open. Stride, with the 12% coupon and exchange listed in May, brought 980 million net proceeds at launch and has a fresh 4.2 billion ATM halo for follow-on taps. These layered coupons meet distinct capital appetites. Insurance funds want Strike, hedge funds nibble Stripe, and yield-hungry retail piles into Stride. But they all share one feature: proceeds head straight into the Bitcoin wallet. And the newcomer was Stretch, the treasury preferred. July's debut added $2.5 billion more. Stretch acts like a granular T-bill alternative for cash managers, yet feeds the same accumulation engine. Total firepower added up roughly $6.8 billion net in Q2, $3.7 billion in July alone, and $45 billion of remaining ATM headroom across all instruments. At today's BTC price, that unused shelf equates to more than 300,000 potential future Bitcoin, effectively a second strategy waiting in the wings. Management is treating the equity and preferred markets like an on-demand mining rig. They monetize the premium when the mNAV is rich, locked in fixed coupons when the yield is cheap, and never swings so hard that Bitcoin per share ever goes backwards. The result is a capital structure engineered to snowball BTC holdings even if spot prices take a little breather. Management wanted a security that feels like a treasury bill to cash managers, yet funnels proceeds straight into Bitcoin. They landed on a non-cumulative investment-grade preferred that pays an 80-cent monthly dividend, just under a 10% annualized coupon at the July IPO price of $90 a share. Stretch sits senior to common equity and junior to existing secured notes, with a mandatory redemption window starting in 2029. Dividends can be paused without triggering default, so the board keeps balance sheet flexibility during a Bitcoin winter, in my opinion, one that will never come again. It's going up forever, Laura. The prospectus also caps total Stretch issuance at $7 billion unless shareholders approve an increase, limiting dilution risk to earlier preferred holders. Pension funds and insurance portfolios crave a liquid, high-yield instrument that still counts as equity for regulatory ratios. Stretch ticks all those boxes. It trades on the New York Stock Exchange alongside Stride, but its lower coupon and senior ranking attract a more conservative audience, widening Strategy's investor tent without cannibalizing the higher-octane Strife or Stride markets. The economic impact has been absolutely monumental for Stretch. July's $2.5 billion net raise brought roughly 21,000 Bitcoin. At the time of settlement, the cash dividend costs about $26 million a quarter, yet the Bitcoin acquired has already marked to market a paper gain north of $400 million. Even flat prices leave Stretch accretive to Bitcoin per share for common holders. Stretch broadens the balance sheet toolkit. The company can now toggle among common ATM, 3 flavors of coupon preferred, and convertible notes, selecting whichever form delivers the greatest BTC yield at the lowest shareholder friction. Stretch's debut proves the market still has an appetite for new structures that convert fiat into digital scarcity, an encouraging sign for future issuance if Bitcoin volatility grants another window. In short, Stretch acts as a bridge. Fixed income discipline on one side, Bitcoin upside on the other, and Strategy collects the toll in fresh Satoshis every month. Management has lifted the hood on full-year expectations, and spoiler alert, the engine is 100% Bitcoin driven. I know, not surprising in the slightest. Headline numbers: operating income $34 billion, net income $24 billion, and a diluted earnings per share of $80 for full year 2025. Those figures assume Bitcoin coasts into New Year's Eve at 150K BTC. Translate the math, every common share is expected to book roughly 0.00053 BTC of profit this year. If Strategy can earn $80 per share with BTC at 150K, it implies a run rate return on equity north of 60%, numbers unheard of outside early stage tech or commodity super cycles. That's right, I said a super cycle. Number 2, it's creating an anchoring narrative. Wall Street models need a base case. By tying guidance to a discrete Bitcoin price, management frames the debate around a single sensitivity knob instead of a spaghetti bowl full of software line items. Number 3, issuance discipline check. Guidance bakes in the current ATM cadence. It signals management won't flood the market with new shares unless mNAV is now above a 2.5x. Yes, all the bears can now finally shut up about the ATM. Let's talk about the sensitivity framework. Every 10K in BTC adds or subtracts roughly $4.2 billion from year-end operating income. Remember that. That's about $1.10 per share. Every 1% change in BTC yield shifts the end-of-year holdings by 6,300 BTC, which can swing equity value another $1 billion at current prices. The software business at 115 million quarterly revenue barely nudges the meter. Think decorative hood ornament on a rock. rocket engine. The key takeaway: guidance isn't a conventional revenue expense story. It's a probability distribution over Bitcoin's year-end price. Treat their 150K peg as the median of management's internal Monte Carlo. If you believe BTC overshoots, the EPS target becomes the floor. If it flatlines, the income statement deflates, but the balance sheet still holds the coins. Either way, strategy remains a levered call option on digital scarcity. Now with GAAP-blessed mark-to-market clarity for anyone doing the math. Before we drown in Satoshis, let's check the original engine that still pays the office rent. Q2 software revenue logged $114.5 million, a modest 2.7% increase year over year, hardly headline-worthy next to a $14 billion Bitcoin gain, yet still a clean fiat-denominated inflow. Subscription service led the growth at $40.8 million plus 69.5%, propelled by the cloud platform's usage-based everything model. Product licenses plus subscription bundles followed at $48 million flat, up 43.9%, confirming that perpetual licenses keep migrating to software as a service. There is erosion in the old guard. Support revenue slid to $52.1 million, down 15.6%, and other services dipped to $14.4 million, down 11.8%. Fewer installs means fewer support contracts and fewer consultants racking up billable air miles. An intentional trade the company is happy to make. Gross margin compressed from 72.2% to 68.8% as cloud hosting costs scaled faster than top-line growth. Management calls this a temporary squeeze. Once subscription APR climbs over fixed infrastructure spend, margins should bounce. Translation: short-term cloud tax, long-term leverage. Strategic value: this is a cash buffer. Even at $115 million a quarter, the software arm covers payroll, R&D, and data center bills, shielding Bitcoin gains from operational drip. And there's a cross-sell credibility. I'm sorry, this is not lost on me. Large enterprises still on board because of analytics. Then get the Bitcoin evangelism keynote for free. Each new software as a service customer becomes a potential strike or stride buyer down the road. And there's an optionality for spin-off. As Bitcoin income dwarfs software income, the relative valuation gap widens. The software business has shrunk from spotlight to stagehand. Everyone knows that. But it is a profitable, cash flow positive stagehand that keeps the lights on while the headline act hoards digital gold. Now this is the fun part, folks, the thing that everybody's talking about, the stuff that everyone's so excited over. Strategy is often characterized as print stock, buy Bitcoin. The reality is a rules-based playbook that treats dilution like a surgical strike, not a carpet bomb. Number one, mNAV as the steering wheel. Management calculates the multiple of the net asset value by dividing the company's market cap by the fair value of its Bitcoin. The quotient, currently hovering around a 1.7, is their internal speedometer. There are now 3 traffic light zones. The mNAV band of above 2.5x, the issuance stance is now only what is needed to settle share-based comp or contractual obligations. For example, if they need to pay dividends. Guidance is now with an mNAV of 2.5 to 4.0x, there are opportunistic taps via the common ATM. Every share buys more BTC than it represents, modestly lifting BTC per share. And with an mNAV band of greater than 4, it is full throttle issuance. Premium is rich enough to accelerate accumulation without really harming existing holders at all. This framework is pinned to the IR page in real time. Why the math protects holders? Because this is a Bitcoin per share yardstick. The delta accretes to everyone's slice even after dilution costs. And it's a cost of capital test. If the blended coupon on preferreds plus the implicit discount on the new common sits below expected Bitcoin appreciation, issuing is additive toward long-term equity value. And it's a self-regulating mechanism. Aggressive issuance pushes the stock price down, compressing the mNAV. That automatically shuts the faucet and forces management back into opportunistic or pause zones. And there's a transparency dividend that's paid, folks. Publishing live mNAV isn't just a courtesy, it's a pre-commitment that deters reckless dilution. Not that they've ever done reckless dilution, let's be clear. Analysts can model in real time how many coins a given print will add and whether the BTC per share rises or falls. In practice, Twitter does the policing long before proxy advisors chime in. The big picture takeaway: strategy has transformed equity issuance from a blunt fundraising tool into a quantitative, hedging instrument. The mNAV tiers create a pass-fail test the company can't hide from, and shareholders get a dashboard that updates faster than most crypto exchanges. In short, the balance sheet expands only when the premium says green light and everyone gets to watch the traffic signal change. Now let's land the plane. Q2 set the new baseline, not the peak. A $14 billion operating profit showed that once fair value accounting met a half-coin treasury, GAAP numbers went from sedan to Star Destroyer overnight. Future quarters will echo that power every time BTC twitches. Number 2, the flywheel is fully self-funded. Between common stock ATM taps and 4 coupon flavors of preferreds, Strategy can raise tens of billions without breaking its Bitcoin per share math ever. Issuance throttles itself via the live dashboard we just discussed, so dilution stays accretive by design. Number 3, BTC Yield is the North Star in the sky, kids. As long as coin growth outpaces share growth, the thesis holds even if spot price flatlines. Management lifted the 2025 target to 30% and is already 4/5 there. Watch that metric. It's gonna go higher than that, I'm telling you. Number 4, guidance is a Bitcoin price option. Fiscal year 25 EPS guidance of $80 assumes 150K BTC. If you're bullish beyond the 150K BTC peg, view the guidance as a conservative floor. If you're bearish, remember the coins stay on the balance sheet. The catalyst on deck, the index inclusion watch. Each month of outsized earnings nudges Strategy closer to that S&P inclusion. It's already eligible, we're just waiting. Passive inflows will be the ultimate flywheel. And macro and FASB ripple effects. Other corporates may follow fair value adoption, normalizing BTC on balance sheets and tightening supply. Folks, Strategy isn't just buying Bitcoin, it's industrializing the balance sheet mechanics of scarcity accumulation. Q2 proved this model works under GAAP lights. The only open questions now are pace, price, and how long the market lets them outrun gravity before the index funds have no choice but to join the chase. This is the ultimate paradigm shift, folks. You are witnessing hyper-Bitcoinization happening in real time. It's time to get rich. But remember, this is not financial advice, this is financial entertainment. My name is Adam Livingston, and I am the Bitcoin Wizard. Please like this video and subscribe to the channel for more daily Bitcoin insights. Have a terrific day. Class dismissed.